Good afternoon and welcome to another video. It is July 7th at about 3 p.m. and it's good to be back. I know I tried to do one of these the end of last week, but then the holiday shortened week got the best of me and rolled forward to the new week. Anyway, a couple of things. One is if you like my video, if you like what you hear, please give it a thumbs up on YouTube. Today we're going to cover a little bit about the election, probably more about where I see the market in the short term, intermediate term. Maybe I'll delve in the long term depending on time. So that's the plan for today. First, if you do not know it yet, we rolled out a new website, which I am going to pull up. And I am begging for constructively critical feedback. I say, hopefully people like it. If you don't, that's okay. You won't offend me. I'm a big boy. So I'm going to share my screen. And the URL is still www.investfortomorrow.com. There's the website. If you have any constructively critical comments, things you think we should change or don't make sense or trouble navigating or things that you really like, pop me an email, Paul at Invest for Tomorrow, and let me know. I would greatly appreciate that. Okay, so let's get rid of that. Now let's go on to, let's start with the election. And why did I pick today? No particular reason other than there has been a preponderance of articles in the media regarding Biden's surge in the polls. So I thought, to answer a question that I am invariably going to get as to what does it mean for the markets, let's get it out of the way right now. So one, I saw in most swing states and in the national polls, Biden has a commanding lead over Trump. You want to call it 7%, 8%, 10%, 11%, pick whatever number you're comfortable with. That's the right number for right now. Because polls in June and July before the election year, they're not meaningless, but we know just as recently as 2016 how quickly they change. But listen, people are talking about it, so let's talk about it. Right now, the polls say Joe Biden is going to win the White House and the Democrats are going to have a blue wave come November. That's what the polls say now. The market's not factoring that in yet because markets typically do not factor in anything for the election until we get to at least Labor Day. Let me repeat that. Biden could be ahead by 20 points or Trump could be ahead by 20 points. The market doesn't care right now, and it probably won't until we get to September at the earliest. And we know from 2016, Trump was failing miserably in the entire primary season, and then when he became the nominee, and really all the way until the shocking election, he was trailing. So be very careful with those mainstream polls. I'm not a pollster, as you know that. There's clearly some kind of flaw in the latest technology in polling. Some of the polls had it right in 2016, so you have to give them credit. Someone's going to ask me which they were, and I know they weren't Fox, CBS, NBC, or ABC, or CNN. They all stunk. I can't remember if it was Real Clear Politics, but it doesn't matter. I'll figure it out. We got plenty of time. It's only July 7th. So election does not matter right now. Second thing on my list, which I just remembered, and I keep saying that on Twitter and on Facebook, this is not this is regardless of the health tragedy and the health crisis, the market does not care about the virus. And I keep saying that. You may care. I may really care. The market does not care how many cases are seen in any state or in any country around the world. Every day is a record number of cases around the world. You want to say it's because of testing? I agree with you. You want to say because people aren't socially distancing? I agree with you. It doesn't matter. The market doesn't care about the virus, period. Don't at me, don't email me. The market doesn't care. The market cares about two things. Now that's four, but really two things. The market cares about What is the economic growth going to be 3 to 6 months down the road? And is Jay Powell and the Fed standing there with their nuclear war of liquidity? Those are the only two things the market cares about, period, end of discussion. I don't have to like it or agree. That's what reality is. I keep seeing almost record amounts of cash in active portfolios. So many of these masters of the universe, Stan Druckenmiller, Icahn, Paul Tudor Jones, you can go down the list of, I think even Soros, haven't made any money on the rally because they don't believe in what's going on. That's okay. That's their prerogative. Oh, the Bridgewater, the guy down the road from me, Ray Dalio. Doesn't matter. That's their thesis, and they're going to run with it. But the market does not care about the virus. The market cares about the Fed and what's economic growth going to be 3 to 6 months down the road. I continue to say, and I'm pounding on the table as my camera shakes, I do not believe the economy will V-bottom. I do not believe economic growth is going right back to where it was in January of 2020. I do not believe that. Personally, I do not believe that. The markets care what I believe? No, that's what I don't believe. I think, as I said all along, the market hit the bottom in the economy, and the economy is going to have a very sharp rebound, but fall well short of the peak it hit in January. Somewhere between 50 and 75% recovery of what it lost. That's my opinion, based on partial fact and partial opinion. Okay, so let's move on to the markets. Let's go to my screen. Let me share this screen in a second. My thesis, if you read the blog, Invest for Tomorrow, oh no, I changed the blog. It's now on the website. So when you go to the website, and you can see on the right side, it says blog, or I'm sorry, go under insights and then blog, you'll see my blog. So for the last month, almost month, I have said the market's been in a new trading range. This is the second time my thesis has been trading range. The first time was the mid-April to mid-May period. I thought we'd be in a trading range, but I did not see this huge rally out of it. I thought we'd poke out of both sides and then have a big run. Didn't happen. We just kind of sort of poked a couple of seconds on the low side and then ran higher. I'm not calling that a huge victory because I thought it would be a little deeper. That's okay. But let me share the screen. All right, now you're seeing my screen. So this is the Dow. New trading range. I know I'm really creative, but you'll see the blue horizontal lines, and these are the highs and the lows essentially from June. And I've said since this big down day, that this is kind of the shock and awe day, that the market was going to be in a trading range for a while. What's a while? A couple of weeks, maybe a month or two. We'll see how it shakes out. But that's the trading range for the woefully lagging, pathetic Dow. It really is woefully lagging and pathetic because the Dow cannot get out of its own way. So there's the Dow. It's pretty, I think, here's the last trading range we had. It just tiny poked out the bottom of it and then took off. I thought it was going to be a little bit deeper to shake people out and then go. Doesn't matter what I think. The market does what it does. Doesn't have to agree with me. I don't have to agree with it. I just better adjust on the fly. So there's the Dow. Let's go to the S&P, which is in light blue. It's the same thing. You'll see the June highs and lows. S&P is a little stronger than the Dow, but I don't think the trading range is ending this week. And let's go to, let's do the Qs. Yeah, why not? Now, let's do the NASDAQ 100 or the triple Qs. There is no trading range here. There wasn't a trading range here. There's been no range since the bottom. The Qs have been the place to be. I mean, this run has been, I'm not going to say epic because that's being an exaggeration. And I'll email the link from the Yahoo Finance interview I did this morning where we talked about, is this the dot-com bubble again? And the shorter answer is absolutely no. Dot-com bubble, remember, companies were trading not on earnings and not even on revenue. They were trading on eyeballs, literally. You get a $5 to $10 billion valuation $50 billion based on the number of eyeballs looking at your screen. Today, the NASDAQ 100, which is dominated by Facebook, Amazon, Google, Netflix, Apple, Microsoft, those are real companies. Those are real companies with real revenue and real positive cash flow, different from the dot-com bubble. So doesn't mean it can't end that way, but it's a different kind of mentality. You also, I'm not going to get into sentiment now. That's a topic for a video in and of itself, but I don't think we're in a dot-com bubble. Is Tesla like a dot-com bubble? It's more so than the NASDAQ 100, I'll say that. But what I said on Yahoo, and I'll forward the link, is that I think this amazing, epic NASDAQ 100 outperformance. So you've got the Dow, the S&P, the mid caps, the small caps. They're in the have-not category. And the NASDAQ 100, but really only a dozen stocks are in the have category. I do think this period of outperformance is going to, I said on Yahoo, I pigeonholed myself, this quarter, Q3, before September 30th, the NASDAQ will peak relative to the other indices. Now, at the same time, I said on Yahoo that I sheepishly own, I have a big position in the NASDAQ 100. And that's because, like a lot of other people, I will say or think that I'm smarter. And then when the game of musical chairs stops, I'll be able to get off and have a chair left. Or I'm sorry, I'll be able to sit down in my chair, but get out. I mean, many of us think the same thing. We're all smarter than everybody else, and we'll be able to make adjustments along the way. That's market ego. I'm okay being wrong for a short period of time. I will not stay wrong. So if this relationship turns dramatically and the NASDAQ 100 begins to underperform, and I own a lot of it, I'll have no problem pulling that ripcord and either rotating into the small caps or the mid caps or something else. I'm not going to sit and pound the table that the market's wrong and I'm right. Those of you who know me know that's not my personality. I make plenty of mistakes every day. That won't be, I don't think that will be one of them. So we're in a trading range in the Dow, the S&P, the mids, the smalls. The NASDAQ 100 is in a world of its own. It is behaving like somewhere between the dot-com bubble and the Nifty 50 of 1973. I was alive in 73. Although I was 7 years old. I do remember talking investments around the dinner table because my dad was in the business. But and I know we really struggled in the 70s. It was not a good time for him. I always remember him saying the reason that we didn't lose our house and go bankrupt was because he was a big believer back then in commodities, and that kept his business alive. But I think we're in a trading range, and for now, that old, expression, which is kind of a little annoying and obnoxious, buy the dips and sell the rips. I think that will treat you well until proven otherwise. So buy the dips, sell the rips. Don't go crazy. I have a very tough time chasing some of these real high flyers. It's not my personality. I think when you chase, you better go with smaller size positions and you better get out early. Don't stay a long time in that game of musical chairs. All right, so we did the trading range. It's bound by the June highs and lows. We did the new website, the election. Oh, let me close with this. My views, short-term, intermediate, and long-term. The shorter the view, the less favorable I have of the markets. So if you're asking me about for a couple of days to a couple of weeks, yeah, I'm not thrilled. I don't love the action. I should probably do another video to tell you why. But I don't love it. You get me out to 6 months and 9 months. I think the stock market will be higher 6 and 9 months from now than it is today. That's the Dow and the S&P, and I'll even go out there and say the mid caps. The Russell and the NASDAQ, I'm not sure. I haven't done enough work yet to have a strong opinion. But I think the Dow and the S&P and the mids will be higher 6 and 9 months from today. And I think I covered everything. Summer's here. You don't hear the media talking about the summer doldrums because the markets are still pretty volatile. And by volatile, if you want to just follow it on your own, you can see on my chart, here is the VIX, which is the volatility index. And for full disclosure, I own the VXX, which I bought at the end of last week. Just for myself, not for clients. It's crazy aggressive and insane to own if you can't watch it all the time. But this is the volatility index. Market, it's very difficult to invest in the market when volatility is expanding on the way up. It makes it very difficult. When volatility goes down, 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 and gets more and more compressed, it makes it easier to invest. So right now, the volatility is 28.70, we'll call it 29. It's a whole lot better than 40, 50, and 85. But I'd love to see the volatility index get below where it was on June 8th. We'll call it 24. Below 30, it gets more investable. Getting below these lows, the post-crash lows of 24, would really increase the bull case. But we'll cross that bridge when we get there. So thanks for watching. If you like what you saw, please give me a thumbs up on YouTube. I will send around my link to Yahoo, maybe with this video if it's up in time. Feel free. You can always call me, email me, Skype me, whatever you want with questions, comments, concerns. Listen, I hope you're all doing well and staying safe. That's the most important thing. It is certainly an interesting time. I know where we are, travel sports started again. So that means my little guy and my daughter are back on the baseball and softball fields, which I said, I'm honest, it makes me nervous. I force them, they're both pitchers, and I force them to use sanitizer in between innings. And yeah, you can call me crazy and an alarmist, and my friends make fun of me. That's okay. I said, make fun of me all you want. I just don't want you to come to my funeral prematurely. So between getting hit by the tree a year ago and the coronavirus, I think I've had enough on the risk front for a while. In any case, I digress, as I normally do. Stay safe, be well, and I'll be back to you shortly. Thanks.